Listen, I want you to picture Helen. She is 71 years old. She lives in a modest brick ranch house on a quiet cul-de-sac in suburban Plano, Texas, north of Dallas. The kind of street where the live oaks are old enough to remember when the subdivision was still pasture, and the kind of house where the foundation has cracked twice in the slab-shifting Texas clay, and been patched twice by the same handyman she has called for 19 years. Her husband Robert died in March of 2024. He was a regional sales manager for a tool and die company out of Garland for 31 years, and his pension was modest, and his life insurance was modest, and the only thing he left her that was not modest was the house. The house, which they bought in 1989 for $96,000, is now worth, according to the Collin County appraisal district, $487,000. They paid it off in 2014. Robert wrote the final check on a Saturday morning, drank a Shiner Bock at noon, and they had a steak dinner that night with the neighbors. He was 64 years old. He had 10 years left. Helen, in October of 2025, opens an envelope from the Collin Central Appraisal District. The envelope is white. The seal is red. The letter inside informs her, in 3 short paragraphs of cordial bureaucratic prose, that her appraised value has been adjusted upward and that her property tax bill for 2026 will be approximately $11,400. Her property tax bill in 2014, the year they paid the house off, was approximately $4,200. Her property tax bill, in other words, has nearly tripled in the 11 years since the deed cleared. Her Social Security check, after the 2026 cost of living adjustment, is $1,940 a month. Her late husband's pension survivor benefit is $620 a month. The math, if you do it the way Helen does it at her kitchen table at 6 in the morning while the coffee gets cold, is that her property tax bill now consumes more than 4 months of her total income. Not 4 months of discretionary income. 4 months of all income. She is paid off. She owns the house outright. She has the deed in a fireproof safe in the closet next to her wedding shoes. And the state of Texas, the friendly Texas that has no state income tax, the Texas that the financial commercials with the silver-haired couples kayaking through a sunlit lake have told her is a retiree paradise, is sending her a bill that exceeds her grocery and utility budget combined. She picks up the phone. She calls her son in Houston. Her son, who is a good man and a busy man and an electrical engineer with 2 children of his own, and a mortgage, and a car loan, and a daughter starting at the University of Houston in the fall, listens for 11 minutes and then says the thing he was always going to say. He says, "Mom, you know I will help you any way I can." He does not say he can pay her property tax. He cannot pay her property tax. His wife's mother is in assisted living in Sugar Land, and that is already $8,000 a month. Helen knows this. She does not ask. Now listen to me carefully. Here is what nobody told Helen and nobody's telling you. Texas, the Texas that brags on every relocation brochure about being a no-income tax retiree haven, has one of the highest effective property tax rates in the entire United States. The average effective rate in Texas is somewhere in the range of 1.6 to 1.8% of home value depending on which county you are in, and in some of the suburbs of Dallas, Houston, and Austin, that effective rate climbs north of 2.25%. That means a $450,000 home is generating, every single year, somewhere between $7,200 and $10,100 in property tax that the homeowner owes whether they have a paycheck or not, whether their spouse is alive or not, whether they are 70 or 93. The state has no income tax because the state does not need an income tax. The state has you. The state has the house, and the house which you paid off is the asset. They tax, not your wage, which they cannot tax, but the structure you sleep in every January until you die or sell. Now stop the video right now. I want you to do one thing for me before we go any further, because the next 30 minutes of this video contain the specific math, the specific code sections, and the specific moves that can keep Helen and you in the house you paid for. If you are over 60 and your home is paid off in the state of Texas or in any state with a property tax system, that means the rest of this video was written for you specifically. And the algorithm in 2026 has a documented suppression problem on senior financial content. The platforms do not want this video reaching the people who need it. The way you fight that is the little thumbs up button under the video. Smash it. Hit subscribe, ring the bell so you get the next warning. And if you have a friend or a sister or a brother-in-law who lives in Texas and just paid off their house and is feeling smug about it, send them this video before the assessment notices go out in the spring. The suits in the legal department want me to remind you that I am not your attorney, I am not your CPA, I am not your financial advisor, and this is not legal advice. This is a survival guide for the American retiree who has been told for 30 years that paying off the house was the smart move and is now discovering that the system has a different definition of smart than they thought. I spent decades inside this system. I'm not going to tell you what the brochure tells you. I'm going to tell you what your county appraisal district will not tell you, what the man in the navy blazer who sold you the variable annuity in 2014 will not tell you, and what your accountant, who is a perfectly nice man named Doug, will not tell you because Doug does not get paid to tell you. I do not work for any of them anymore. I am telling you. Now here's the first layer of the trap, and this is the layer that catches almost every Texas retiree who walks into the appraisal district office at age 65 with a smile on their face, thinking they are about to lock in their property tax bill for the rest of their life. They are not. They are locking in approximately half of their property tax bill for the rest of their life, and the other half is going to keep climbing every single year until they die. Texas has what is called the over 65 homestead exemption and the over 65 tax ceiling, sometimes called the property tax freeze. It is in the Texas Tax Code, Section 11.26 specifically, and what it does, in plain English, is freeze the school district maintenance and operations portion of your property tax bill at the dollar amount it was the year you turned 65 and qualified. Pay attention to those three words: school district, maintenance, and operations. That is what gets frozen. That is all that gets frozen by default under state law. Here is the dirty trick. The school district M&O portion of your Texas property tax bill is roughly 50 to 55% of the total bill in most counties, which means the other 45 to 50%, the county tax, the city tax, the community college district tax, the hospital district tax, the road and bridge tax, the MUD or municipal utility district tax, if you live in one of those endless North Texas suburbs that built itself on bond financing. None of that is automatically frozen for you at age 65. None of it. That part keeps growing every year with the appraised value, capped only by the 10% homestead annual cap on the appraised value, which in a hot market like Plano or Frisco or Cedar Park or Round Rock hits the cap every single year. Now, Texas Tax Code, Section 11.261 allows counties, cities, and junior college districts to adopt their own optional over 65 tax ceiling. Some of them have, some of them have not. Whether your county froze its portion in 2003 or 2008 or never is a coin flip that depends on what your commissioner's court decided 15 or 20 years ago when you were not paying attention because you had a job and kids and a mortgage. In Collin County, where Helen lives, the county adopted an optional ceiling. The city of Plano did not until comparatively recently, and even then with limitations. The community college district has its own rules. The hospital district has its own rules. Helen, at age 65, was given a piece of paper at the appraisal district office that told her, with bureaucratic understatement, that her school taxes were frozen. The clerk did not say, and the form did not say, and the website did not say in plain English, that the rest of her bill was not frozen and would continue climbing. That is the first layer. The freeze is partial, the freeze is fractional. The freeze is, in the language of the Texas Tax Code, only on a specific taxing unit's specific maintenance and operations rate, and the appraisal district employee who hands you the form has no obligation to explain to you what is not covered. The brochure says property tax freeze. The reality says about half of your bill is frozen and the other half is climbing 8 to 10% every year. Helen, when she does the math at her kitchen table, realizes she has been losing roughly $400 to $600 per year, every year for 6 years, to the half of the bill that nobody told her was unfrozen. Now listen carefully, because here is the second layer, and this one is sneakier than the first. The freeze, the partial freeze you do have, can be lost or recalibrated in ways that nobody at the appraisal district will warn you about until after it happens. Here's the first way. If you make what the tax code calls a substantial improvement to the home, the frozen ceiling resets upward to reflect the new improvement. Substantial improvement does not mean replacing a toilet. It does not mean a coat of paint. it does mean a new addition, a converted garage, a major remodel that requires a permit and increases the appraised value above what is called the routine maintenance threshold. So the 74-year-old widow who decides in 2026 to convert her dining room into a downstairs bedroom because her knees no longer trust the stairs, that conversion, if it requires a permit and gets reported to the appraisal district, can recalibrate her frozen ceiling. The ceiling does not jump up to current market value. It is adjusted by the proportional value of the improvement. But it does adjust, and the homeowner is rarely told this in advance by the contractor or the city permitting office. Here's the second way the freeze gets lost: the surviving spouse rule. Under Texas Tax Code, Section 11.26, when the qualifying senior dies, the surviving spouse can continue the frozen ceiling only if that surviving spouse is at least 55 years old at the time of the qualifying senior's death, and the home remains the surviving spouse's residence homestead. Listen to that again. 55 years old. Most surviving spouses of senior retirees are themselves seniors and meet this requirement comfortably. But for the second marriage, for the husband who remarried at 72 to a woman who is 51, for the household where the younger spouse is in her late 40s or early 50s when the older spouse passes, the freeze can be lost entirely, and the property tax bill on the home can spring forward to the current full assessment with no ceiling protection at all. I have watched this take a widow's property tax bill from approximately $3,700 to approximately $7,200 in a single tax year. That is not a typo. That is the math of a 48-year-old widow trying to keep the house her 73-year-old husband paid off 3 years before he died. Here is the third way the freeze can be lost. If the homeowner moves, the frozen ceiling does not automatically transfer to the new home. There is a portability provision under Texas Tax Code, Section 11.26, sometimes called the transfer of the school district tax ceiling, but it does not transfer the dollar amount, it transfers a percentage relationship. The mechanics are complicated, and most county appraisal districts have a form for it, and most homeowners over 70 do not know that form exists. So the 81-year-old widow who sells the big house in suburban Houston and downsizes to a townhouse in the Woodlands frequently discovers, 6 months later, that her frozen ceiling did not move with her in the way she thought it would, and her property tax bill in the smaller, less expensive home is somehow higher than it was in the bigger home she just left. The freeze, in other words, is a fragile thing. It is fractional, conditional, and partially portable. It is not a permanent shield. It is a half-built fence with several holes, and the appraisal district has no obligation to tell you where the holes are. Now here's the third layer, and this is the layer that catches the homeowner who already knows about layers 1 and 2 and thinks they have found the escape hatch. They have not. They have found the slow-motion confiscation device. Texas Tax Code, Section 33.06, allows a homeowner aged 65 or older or disabled to defer property taxes on the resident's homestead. What does defer mean? It means you do not have to pay the property tax bill each year. You can sign a deferral affidavit at the appraisal district, file it with the county clerk, and the property taxes stop coming due immediately. The home cannot be foreclosed on for the unpaid taxes during the deferral period. The taxing units cannot force a sale. This sounds to the 73-year-old widow whose Social Security cannot cover the $11,000 tax bill, like the cavalry has arrived. It is not the cavalry. Let me tell you what actually happens mathematically, word by word, so you understand the size of the crime. When you defer your property taxes under Section 33.06, the unpaid taxes accrue interest at 5% per year, every year. The interest is not waived. The principal is not waived. The taxes are not forgiven. They are postponed. And the lien sits on the property the entire time. When the deferring homeowner dies, or when the home is sold, or when the homeowner moves and the property is no longer their residence homestead, at that exact moment, all of the deferred taxes, plus all of the accrued interest, become due in a single lump sum, within 180 days, from the home in cash, or the home gets sold to pay it. Here is the dirty math. Let us say Helen, at age 73, signs the deferral affidavit because she cannot pay her $11,400 tax bill anymore. She lives another 17 years. She dies at age 90. The taxes she deferred over those 17 years, with the appraised value continuing to climb, and the unfrozen portion of her bill continuing to climb, averaged roughly $13,000 a year by the later years. Total deferred taxes over 17 years, somewhere north of $190,000. The accrued interest at 5% applied to the running balance adds approximately $70,000 on top of that. So when Helen dies, the lien on the house she paid off in 2014 is in the range of $260,000. Her son inherits the house. The lien must be paid within 180 days. The house is worth approximately $620,000 by then. The son, who could not pay her property tax in 2026, cannot write a $260,000 check in 2043. The house gets sold, the lien is paid. The remaining equity, after closing costs and the lien payoff, is approximately $300,000 instead of the $620,000 it could have been. That is the third layer of the trap. The state of Texas, very generously, did not foreclose on Helen. The state of Texas waited. The state of Texas let her stay in the house for 17 years, and the state of Texas, in the end, collected its tax with interest, on schedule, from the heirs, who learned what compounding does in the wrong direction. The state is patient, the state is waiting, the state has built the trap exactly the way it was designed. Now you might be wondering how this got built. You might be asking yourself how a state that prides itself on being friendly to retirees ended up with a property tax system that quietly siphons hundreds of thousands of dollars from the paid-off homes of widows. This is not an accident. This is not bad luck. This is the system working exactly the way it was designed. The Texas property tax system has its origins in the 1876 Texas Constitution, which is one of the oldest unrevised state constitutions still in operation in the United States, and which prohibits a state income tax in language so explicit that it would take a statewide constitutional amendment to change it. Article 8 of that Constitution sets up the basic taxation framework, and the framers, who were rebuilding a state economy after Reconstruction and were terrified of centralized state power, decided that taxation would be primarily local and primarily on real property. That was 1876. The world has changed. The Constitution has not. The property tax remains the backbone of the state's revenue. In 1979, the Texas legislature passed the Property Tax Code, the modern statute that governs everything we are talking about. In 1997, the legislature created the school district tax ceiling under what became Section 11.26. In 2003, the legislature expanded the optional ceiling to cities and counties under Section 11.261. In 2019, Senate Bill 2 capped the rate at which local taxing units could raise revenue without voter approval, the so-called 3.5% cap, which was supposed to slow the climb. In 2023, Proposition 4 raised the homestead exemption to $100,000 for school district taxes and added some appraisal cap protections for non-homestead properties. Each of these reforms was sold as relief. Each of these reforms left the underlying machine intact. The machine is this: a state government that does not tax income, that relies on local property taxes to fund schools, counties, and special districts, and that cannot be turned off without rewriting the Constitution. The legislature, every 2 years, passes another patch. The patches narrow some bleeding and leave other bleeding open. The widow with the paid-off home is not a constituency anyone champions, because the widow with the paid-off home does not lobby, does not donate, and does not show up at the Capitol in Austin in red shirts. The home builders do, the school districts do, the local government associations do. The system rewards the people who built it and punishes the people who paid for it. That is the villain. Not a politician, not a party. The machine. The 1876 Constitution. The 1979 Code. The patchwork of statutes that nobody, including the state representatives who voted for them, fully understands. Now I want you to do something for me right here, right now, before we get to the strategy section. Open the comment section under this video and tell me 3 things. 1. What county in Texas you live in, or what county you are thinking about retiring to. 2. What your current annual property tax bill is. Even an approximate number is fine. And 3. The age of the senior in the household, who is or will be claiming the over 65 exemption. Drop your field report. The comment section under this video is the field hospital for Texas retirees who have just figured out that the brochure lied to them. I read every single one. I cannot answer every single one personally, and I am not allowed to give legal advice anyway. But I can see the patterns, and I can use those patterns to write the next video that hits the exact problem you are facing. If you are not in Texas, if you are in Florida or Ohio or anywhere else that has a property tax system that punishes paid-off homes, the back half of this video will speak to your situation too, and we will hit 3 states specifically in the regional section coming up. But drop your comment now. The algorithm rewards comments more than likes, more than watch time, and more than subscribes. The comment is the loudest signal you can send to push this video to the next retiree who needs it before their appraisal notice arrives. Let me show you what could have happened if Helen, or you, had walked into a CPA's office or a tax strategy attorney's office at age 63 or 64 with this video on the phone instead of walking into the appraisal district office at age 65 with a smile and an expectation. Here is what the moves look like. The first move costs nothing, and most Texas homeowners over 60 leave money on the table because they do not know all the exemptions exist. There is the general residence homestead exemption, which every homeowner in Texas is entitled to apply for on their primary residence. There is the over 65 homestead exemption, which stacks on top of the general homestead exemption. There is the disability homestead exemption, which can be used instead of the over 65 exemption if the homeowner qualifies. There is the disabled veteran homestead exemption, which can fully exempt the home in some cases. There is the surviving spouse of a first responder exemption. There is the surviving spouse of a disabled veteran exemption. And there are county and city local option additional homestead exemptions in many jurisdictions, which can be either a percentage of the appraised value or a flat dollar amount. The over 65 exemption, as of the 2023 constitutional amendment, gives an additional $10,000 exemption against school district taxes on top of the $100,000 general homestead exemption. That is $110,000 of value carved out from school district taxes before the freeze even comes into play. Most homeowners file the general homestead and stop. They never file the over 65 even when they reach the qualifying age. They do not know it is a separate application. The application is one page. The form is called Form 50-114. The deadline is generally April 30th of the year you turn 65, though late filing is allowed up to 2 years back. If you are 65 or older right now and you have not filed Form 50-114, pause this video, write that down, and put it on the refrigerator. The second move costs almost nothing, and most Texas homeowners over 60 have never done it. Every year, when the appraisal district sends you the notice of appraised value, you have the right to protest. You can protest informally with a county appraiser. And if you are not satisfied, you can protest formally before the appraisal review board. The grounds for protest are typically that the appraised value exceeds the market value, that the appraisal is unequal compared to similar properties in your neighborhood, or that there is an error in the description of the property. The deadline to file the protest is generally May 15th or 30 days after you receive the notice, whichever is later. The reason this matters even if your school taxes are frozen is that the unfrozen portion of your bill, the county tax, the city tax, the special districts, those are calculated against the appraised value, and if you can knock the appraised value down by 10 or 15%, you knock down the unfrozen portion of your bill by the same percentage. Helen, in Collin County, with an appraised value of $487,000, could realistically protest down to $440,000 or $450,000 based on comparable sales, and that would save her somewhere in the range of $500 to $700 per year on the unfrozen portion of her bill. Over 15 years, that is between $7,500 and $10,500 she keeps in her checking account instead of mailing to the county. The protest takes about 3 hours of preparation if she pulls comparable sales from the county appraisal district website. 3 hours once a year for $500. That is more than $150 an hour, tax-free. The third move requires you to call your county appraisal district and ask a specific question. The question is, does my county, my city, my school district, or my MUD offer any local option exemptions for residents' homestead that I am not currently receiving? Many counties offer an additional percentage exemption on top of the state-mandated exemptions for over 65 homeowners, and most of those local option exemptions require a separate application form. Some counties offer a flat dollar exemption of $3,000 or $5,000 or $10,000. Some cities do the same. Some school districts do the same. The aggregation of these local option exemptions, when properly stacked, can knock another $15,000 to $30,000 of value off your tax base. And if you have any documented disability, including the kind of medical conditions that many retirees over 70 have and have never bothered to officially document, the disability homestead exemption can be significantly more generous than the over 65 exemption in some jurisdictions. The application requires medical documentation. Your doctor signs a form. The form goes to the appraisal district. The disability exemption can be applied even if you are not yet 65, and in some cases, the disability classification provides protections that the over 65 classification does not. The fourth move is the hardest because it requires the homeowner to confront a decision they have been postponing. If the unfrozen portion of your property tax bill is consuming more than 2 months of your household income each year and your home equity is more than $300,000, you have to do the math on staying versus downsizing. Here is the side-by-side. Helen, age 71, stays in the $487,000 home. Her property tax bill climbs from $11,400 this year to approximately $14,500 by age 80 and approximately $17,000 by age 85. Over 15 years of staying, she pays roughly $210,000 in property tax. If she takes the deferral route at age 75, she loses another approximately $90,000 in interest and compounded deferrals out of the eventual estate. Helen, the second version, downsizes at age 72. She sells the Plano house for approximately $475,000 after realtor fees. She moves to a $190,000 townhouse in a smaller jurisdiction outside the major metroplexes, perhaps in Ennis or Corsicana, or a smaller community south of Dallas, where the property tax rate is closer to 1.7% and the appraised values are lower. Her new property tax bill, after applying for the over 65 exemption and the homestead exemption in the new county, is approximately $2,800. She nets approximately $280,000 in cash from the downsizing, which she puts into a portfolio of laddered treasury bills and CDs, generating approximately 4% annual income. Her property tax bill goes from $11,400 to $2,800. Her income goes up by approximately $11,200 per year from the investment ladder. The total swing in her annual cash flow is roughly $19,800 per year, every year for the rest of her life. The difference between these two Helens over 15 years is somewhere north of $300,000 in retained wealth. Not a year, the total. The difference between dying with a paid-off house that had to be sold to pay a tax lien and dying with a paid-off townhouse and a portfolio she actually used. The fifth move is to understand the tax deferral under Section 33.06 for what it is. It is not free money. It is not a gift from the state. It is an interest-bearing loan against your home equity, secured by a lien that compounds over decades. Use it only when you have already made the downsizing decision impossible, and you are choosing between losing the house this year or losing the equity over time. If you are using the deferral the moment you sign that affidavit, you should also be signing a real estate listing agreement or starting the downsizing conversation with the family, because the deferral does not stop the bleed. It only delays who has to mop it up. The sixth move, if you cannot or will not downsize, is to talk to an estate planning attorney about a structure that protects whatever home equity remains for the heirs. A revocable living trust does not protect against the property tax lien. The lien is on the real property, not the legal owner. But a properly structured plan can include life insurance, owned outside the estate, that gives the heirs the liquid cash to satisfy the deferred tax lien within the 180-day window, so the home itself does not have to be sold under duress. A term policy on a healthy 68-year-old runs much less than people assume, and a specific calculation tied to the projected deferral balance is the kind of thing the attorney can model in an afternoon for less than the cost of 1 year of unfrozen property tax. Now let us pull the lens back and look at 3 states so you can compare what Texas does to what other states do, because the property tax pattern looks different depending on where you sit. In Florida, the property tax system has a homestead exemption of $50,000 and an additional senior exemption that some counties offer up to $50,000 more on county and city taxes. The bigger Florida protection is the Save Our Homes assessment cap, which limits the annual increase in assessed value to 3% or the rate of inflation, whichever is lower, for as long as the homeowner stays in the same homestead. That cap, over 20 or 30 years of ownership, dramatically suppresses the assessed value compared to market value. A house in Tampa or Sarasota purchased in 1995 for $120,000 and now worth $600,000 may be assessed at only $220,000 because of the cap. The trade-off is that the cap resets when the home sells, which makes downsizing painful for Florida seniors who have been in the same house for 30 years. There is portability under the Save Our Homes provision, but it is partial and complicated. In Ohio, the property tax system uses a homestead exemption for seniors aged 65 or older that exempts roughly $26,000 of market value from taxation, subject to an income test that as of 2026 caps eligibility somewhere in the upper $30,000 range of Ohio adjusted gross income. The income test means that many middle-class Ohio retirees with modest pensions and modest IRA withdrawals do not qualify for the senior exemption at all. Ohio also has no statewide property tax freeze for seniors comparable to the Texas Section 11.26 ceiling, although there are local option programs in some counties that allow tax deferrals for low-income seniors. The widow in Akron with the paid-off house and a $60,000 combined retirement income gets no senior exemption in Ohio. She pays the full tax bill. In California, Proposition 13, passed in 1978, caps the property tax rate at 1% of the assessed value and caps the annual increase in assessed value at 2% per year for as long as the homeowner stays in the same property. This is the most aggressive cap in the country. A California homeowner who bought a house in 1985 for $220,000 may be paying property tax on an assessed value of $370,000, even though the home is now worth $1.5 million. When the homeowner dies, the assessed value generally resets for the heirs under Proposition 19, which took effect in 2021 and significantly tightened the parent-to-child transfer exclusion. Proposition 19 also allows homeowners over 55, severely disabled, or victims of natural disasters to transfer their assessed value to a new home anywhere in California, up to 3 times. California is a high-rate state with a low effective tax on long-time resident system. Texas is a no-income tax state with a high effective tax on everyone system. The retired Californian who has been in the same house for 35 years pays a fraction of what the retired Texan in a same-value house pays. The retired Texan benefits in other ways, like having no state income tax on retirement withdrawals, but the property tax differential is dramatic. 3 states, 3 completely different patterns. The lesson is not which state is better. The lesson is that every state has a property tax pattern, and the homeowner who does not understand their state's specific pattern is the one who gets engineered out of equity. Now listen to me one more time before this video ends. The window is narrower than you think. The Texas legislature meets in regular session every 2 years, and the next session begins in January of 2027. There are committee hearings scheduled in the interim period on property tax reform, on appraisal district reform, on the homestead exemption structure, and on the school finance formula. Every 2 years, the legislature passes another patch. Every 2 years, the patches leave most of the machine intact. If you are 63 years old right now, you have approximately 18 to 24 months before you qualify for the over 65 exemption, and that is the moment you need to walk into the appraisal district office with every form in hand, with every local option exemption identified, and with a notebook of comparable sales for next year's protest. If you are 68 or 71 or 75 years old right now and you have never protested your appraisal, never filed for the additional local option exemptions, never had a conversation about downsizing, or about the deferral, or about the lien, the clock is ticking right now. The 2026 appraisal notices go out in the spring. The protest deadlines come in May. The exemption application deadlines come at the end of April. There is no version of this where waiting helps you. There is no version of this where the appraisal district calls you at home to remind you about a form you forgot to file. The system is patient. The system is waiting. The system has built the machinery to keep collecting from the paid-off home, regardless of who owns it and regardless of whether they can afford it. You are the one who has to interrupt the collection. Save this video right now. Bookmark it. Add it to your private library. This is your survival manual for the Texas property tax system in 2026 and 2027. Hit the like button so the algorithm sends it to the next retiree in the Texas suburbs who is staring at an appraisal notice and a social security check that does not match. Hit subscribe and ring the bell so you get the next warning before your next appraisal notice arrives. Drop a comment with your county, your age, and your tax bill. And then pull out your phone, hit the share icon, and send this video to the widow on your street who refuses to talk about money because it feels morbid, the retired teacher who keeps saying she will deal with it next year, or the brother-in-law in Houston who just paid off his house and is feeling smug about it. One conversation now saves them $75,000 later. Tonight is the night, not tomorrow. Tonight. Call the CPA in the morning. Call the appraisal district. Call the estate planning attorney. Stay sharp, stay angry, stay strategic. The Texas property tax freeze trap was built for the retiree who does not know it exists. You know now. Go act like.